Well, folks, we are dealing with the most hated stock market that I have seen in my 15 years of being in the stock market. This is the most hated stock market I have ever seen. I got a lot I want to take you guys through that I'm going to show you a lot of things in this video we don't usually talk about on the channel. I'm going to show you very specific performance in the market, what's actually doing really well, what's doing really bad, how to decipher this information. We're going to talk about opportunities in this market, things to stay away from, and kind of where things are headed here. So it's going to be a busy action-packed video as always. I appreciate y'all joining me. But before we get into all that, why is this stock market so hated right now? This is the most hated stock market I've ever seen, okay? And probably the most hated stock market we've seen in decades. I'll tell you why. Let's go back in time for a moment, 9 months ago, 12 months ago. What were most people doing in the stock market 9 months ago and 12 months ago? They were selling their stocks. They were moving to cash positions. They were moving to consumer staples, what is seen as like safety stocks, even like oil and gas stocks. A lot of people were moving money to, right? They were moving their money to put positions, convinced the market was going to tank a lot lower. They were moving their money to short positions, okay? And almost no one was bullish on the market if we go back 9 months ago. Very, very few, right? And what has happened is everybody that positioned that way, all the masses that went to cash, all the masses that went to short positions, put positions, the consumer staples, the oil and gas stocks, everywhere that everybody positioned 9 months ago and 12 months ago has not been working at all. And they've been absolutely obliterated. And that's how you get into the stock market, that it becomes the most hated stock market, because a lot of people are looking out and saying, like, why wasn't I buying? Why wasn't I buying more? Why was I shorting? Why was I buying puts, right? Why was I, going all to cash and these sorts of things? And that's how you get the most hated stock market we've seen in, honestly, decades. I appreciate everybody joining me for this video. As always, a lot to get through, a lot to go through in this one here today, folks. By the way, if you enjoy the channel and you ever want to say hello to me, Financial Education Jeremy on Instagram, you can always send me a DM on there. There'll be a pinned comment down there if you want to say hello to me on IG, okay? So where I want to start out today is looking at kind of sector performance, okay? Now, this was as of yesterday, so keep in mind some of these numbers could be changed a little bit. This was as of yesterday, okay? S&P 500 up about 10% roughly year to date. Communication services is in a massive bull market right now. I mean, massive bull market, right? Almost 34% up. Consumers discretionary, almost 20% up. Meanwhile, you got Red Dead Redemption and a lot of things, right? Consumer staples is down. Energy's down. Financials are down. Healthcare is down. Information technology is in a massive epic bull market, 35% plus up this year, right? Materials is down. Industrials is down. Real estate's down. Utilities, everywhere they were telling you to put money 9 months ago and 12 months ago has been wrong. Everywhere, okay? In the places they were telling you not to put money 9 months ago and 12 months ago have been absolutely performing extraordinary this year and for the past 9 months or so, okay? Absolutely incredible. Now, if we take this a step deeper, right, there's things going on in the market that sometimes don't usually make sense, right? So if you look at housing, for instance, right, home building's up very nice. Like home building's in a bull market right now. Like look at the performance this year, 24% plus up for home building, right? Meanwhile, look at household appliances, down 7%, right? Home and improvements down. I mean, those don't usually go together. Like usually if home building's up that big, household appliance is going to be up big. Home improvement retail is going to be up big. Everything's going to be up big, right? And the same thing goes on the downside. If everything's down, everything's down. Or if one of these is down big, then they're all down, right? But we have a very strange housing environment going on, right? We have a housing environment going on where new builds are still holding up very, very well in terms of new construction because a lot of people don't want to sell their existing homes. Why don't they want to sell their existing homes? Well, they're locked in at 2.9% mortgage rates, 3%, 3.1%, 3.2%. And right now, mortgage rates have, 6, 7%. I've heard of some people, if you got a little worse credit, maybe potentially paying up to 8% mortgage rates recently. So if that's a scenario, like, why would you sell your house? It doesn't make sense, right? And so this is why home building is doing well. But meanwhile, things like household appliances, home improvement retail, think about Home Depot and Lowe's, are not doing well right now. Meanwhile, on the flip side, right, because overall housing sales are bad right now in terms of existing home sales, auto parts and equipment is basically trying to eke out a gain, but it's basically flattish for the year. Meanwhile, automobile manufacturing is up 53%, and automotive retail is down 1%. It's one of those things you look at and it's like, how does that make any sense? Automotive manufacturing is in this massive epic bull market. And meanwhile, auto parts and equipment's down, or let's call it flat, and automotive retail is down for the year, right? That's incredible to see something like that. This is what we call, folks, we call this guess what? Stock pickers market. That's what we call this, folks. This is a stock pickers market. S&P 500 consumer discretionary, right? Look at this. Casinos and gaming up big. Hotels, resorts, and cruise lines up big. Restaurants up big for the year. These are having great years this year. But here we are. You would think these would be doing bad, right? Because, after all, we had the worst inflation we've had in decades that the consumer's been hit with. And meanwhile, all these things these are not needs-based things. These are wants. Going to the fancy, the restaurant to spend $100 is not a need, right? That's a want. Going, on trips and going on cruises and all these things, right? Going to Vegas, my city. I appreciate y'all. They come to my city, right? Those aren't needs. Those are wants. Let's be quite frank about that, right? And so you're coming off the worst inflation in decades, and meanwhile, people are still got money to spend. Clearly, right? No, check this out. Consumer discretionary. Specialty stores is down over 11% this year, right? And so it's like, wait a minute, is a consumer fine or is a consumer not fine, right? Because this basically says the consumer's doing tremendous. And then you go ahead and look at this and you're like, wait, is a consumer doing good? Because why is these specialty stores down so huge, right? Heck, it goes off the charts on Yarndini. Come on, Yarndini, what do we got going on here, baby? We got these charts going off the charts. Like, come on, man. What's going on here, right? But this is where you get into a lot of confusion. This is what we call a stock picker's market. Check this out, right? We got more lines going off charts here, okay? Consumer staples. Check this out. Consumer staple sector's down this year. Brewers are having a great year, surprisingly enough. You got D-Rug retail down 18.8%. You got household products down. You got hypermarkets and supercenters down, slightly up 2% for the year. You got personal products down substantially for the year, 26%. Oh my gosh, okay. Soft drinks are down for the year. Tobacco is down for the year, right? And so you want to take a look at that, and it's like consumer staples. Oh my gosh, like what are these stocks? But remember, what was the crowded trade last year? Consumer staples. Oh, what were they telling you 9 months ago, 12 months ago? Hey, if you're going to put money in the market, put it in these sorts of stocks, right? If you're going to put in your money somewhere, put in these sorts of stocks. And we can see the performance of those. It's been absolutely a complete disaster, right? Energy. Look at energy. The energy sector obviously down double-digit percentage this year, right? Integrated oil and gas down almost 10%. Oil and gas equipment services down 15% as a sector, right? Oil and gas exploration and production down almost 15%. Oil and gas storage and transportation down almost 11%. Oil and gas refining and marketing down about 12%. But also remember this, right? Energy in 2022 was the crowded trade. Everybody and their grandma I'd watch go on CNBC. What did these folks tell you? Okay, I'd watch 100 hours of CNBC, okay, a week. Maybe not that much, okay, but a pretty good amount, right? Listen, these Wall Streeters go on there, tell everybody, you need to be in oil and gas. This was all throughout last summer, all into the fall time. And I kept telling you guys, you can position that way if you want, but you get ready because there's a reckoning coming. It doesn't make sense. If you're bearish on the economy, oil is going to go down substantially. And also, we just went through a kind of an epic bull market, and it's a crowded trade. Everybody's already playing it. If everybody's already playing it, on these commodities don't stay high forever. They're not like a stock where, a company can keep getting better net incomes, better EPS, right? And the stock price can just keep moving and moving for years and years or decades and decades. Commodities don't work like that. These go through huge boom and bust cycles. And so, I called that 100%. Unfortunately, I didn't, participate in any put options or anything like that. I should have. But nonetheless, folks, energy was the crowded trade. And those people have gotten absolutely wrecked now at this point in time, right? Now, check out financials. Financial sector in general is down over 6.5% this year, right? Asset management in banks are down over 7%. Consumer finance is up, surprisingly, 9%. Diversified banks down over 6%. Financial exchanges and data is actually up year to date. Insurance brokers up about 4%. Investment banking and brokerage is down almost 17% this year. Regional banks, down over 35% this year, 37% roughly. Reinsurance, slightly with a gain. Once again, this goes into a stock picker's market, folks. You got some that are doing absolutely horrible and some that are doing great. Look at healthcare. Another perfect example of what was everybody telling you the middle of 2022 and the back half of 2022, and even the beginning of this year, position into healthcare. Look at how the healthcare is done. It's awful. Healthcare sector in general is down 5.5% this year. Biotech is down almost 12%. Healthcare equipment is let's see, slight gain here. Healthcare services down 22%. Managed healthcare down 7.7%. Pharmaceuticals down almost 6% this year. It's another overcrowded 2022 trade that everybody was positioning into. And obviously, it's just the air has been let out of that balloon, okay? Then you go ahead and take a look at this, right? Information technology sector is up 35%. Application software is up almost 30% this year. Communications and equipment's up 8%. IT consulting and other services up 3%. Home entertainment software, let's call it about flat, okay? It's slightly with a gain. Semiconductor equipment's up almost 24% this year. Semiconductors, 65, almost 66% gain this year. Incredible. System software up almost 38% this year. Technology, hardware, storage, and peripherals up about 37.5% this year, folks, okay? Wow, that goes to show you the difference in how the market's performing and what's actually in a massive bull market versus maybe what's in a bear market. Even if I look at my own personal portfolios, I have stocks that are in an epic bull market and I have stocks that are in an epic bear market right now. A good example is Meta, right? Meta is in an extreme bull market right now, okay? Meta's in its own game. I mean, this is a stock that, now we're up 122% on. We're now up $273,000 in this stock. And it seems like it just goes up day after day after day after day. I think the stock's, $273 or so here today, right? Is the stock $400 by year end? I wouldn't be surprised, to be honest, especially given what I think's coming for EPS down, these next few quarters. I wouldn't be surprised if 400 is coming. And that stock seems like it's up day after day after day. Meanwhile, Revolve is a stock I own that's doing absolutely horrible. Yeah, we're up about 42% on the position, but let's not forget we were up a lot more in the past on this position, right? This stock has lost about 40% of its value this year. Revolve stock, RVLV, is in an epic bear market for that stock right now, okay? It's the complete opposite of Meta. Meanwhile, Tesla is in a massive bull market for the company right now, right? Up 97% year to date. 97%. That's basically investors saying this one got way oversold last year, and ultimately their business is going to be a lot better next year than it is this year, right? There was Cybertruck coming down the pipe. I wouldn't be surprised, right? Up 97%. Meanwhile, look at a stock like Oatly I own, right? Down 15% this year. Down double-digit percentage. That one just can't do anything right now, right? In terms of the stock price, at least, right? You look at a stock like Palantir, 127% gain year to date, right? We were in the red in a quite a substantial way on Palantir, right? At one point. And now we're in the green massively. I mean, this stock's doing tremendous now at this point in time, right? We're up $32,000 in this position. Now you go ahead and look at something else. Look at Foot Locker, right? We're now red on Foot Locker, right? I'm down 4% on this stock. And going into this year, I was up very nicely in the green. This stock's down 31% year to date, right? This just goes to show you how much of a divergence we have in the market, folks. This is the quintessential stock picker's market. Now, a stock picker's market, what is a stock picker's market, right? I wouldn't call a bull market a stock picker's market. I wouldn't call a bear market a stock picker's market, right? A true bull market, you should see the S&P 500 moving up in a substantial way, the Russell stocks all moving up in a substantial way, every single sector pretty much moving up in a substantial way, right? NASDAQ moving up in a substantial way with the Dow. And so a bull market, I wouldn't consider a stock picker's market because that's just everything's going up, everything's mooning, right? And we're certainly not in that market right now. Look at the performance year to date for many of these sectors. They're in their own bear markets, to be quite frank, right? Now, also, a stock picker's market is not a bear market, right? Because in a bear market, it just seems like everything is going down. You can't catch a break, right? From the long side, at least, right? So it's not really a stock picker's market. It is from a long-term perspective, like I'm buying these stocks for the next 3, 5, 7 years. So it's a stock picker's market in that respect, but it's ultimately not a stock picker's market either, right? A market like we're in right now, which I call kind of like a kangaroo market, this is a stock picker's market, where you have these massive divergences between NASDAQ, S&P 500, Russell, Dow Jones. This is a stock picker's market. And I have news for you, okay? And so doesn't, folks like Stanley Druckenmiller, right? Legendary investor. This stock pickers market might not end anytime soon, because we're going to have these moments in the market where everything looks great. It looks like all clear. The economy looks great. Inflation looks like it's coming down. Then we're going to have worries about the economy. Then we're going to have worries about inflation. And it's going to cause continued volatility in the market. We have a lot of geopolitical problems that are going to happen from time to time. That's going to cause the market to get shaky. And so this market that we've been going through for honestly probably the past 18 months now at this point in time, this is what you could be looking at for years to go in the future, to be quite frank. Where there's going to be certain stocks that are doing absolutely tremendous, and they're playing their own game. They're like in their own bull market. And meanwhile, you got a massive amount of other stocks and sectors that are doing absolutely horrible. And so as a stock picker out there, you got to find where the opportunities are in the market and go ahead and pounce on those opportunities when you get those opportunities given. The stocks I was buying 6 months ago or 9 months ago are not the same stocks I'm buying today. I can tell you that much. And I can tell you the stocks I'm buying today are not going to be the same stocks 9 months from now, because of how much these stocks can underperform or overperform the market. And I don't see this ending anytime soon, to be quite frank, folks. I think we're going to continue to have this, where the market's shaking around and, 1 minute it's going great and the next minute it's going horrible. And I think ultimately it's going to continue to be a stock picker's market overhaul, okay? And so this is one of those that if you only know how to put money in an index fund, I think you could be in trouble. And legendary investors are saying you're going to be in trouble this next decade, because, there's going to be certain people making so much money, and there's going to be a lot of other folks saying, when does my account go up, right? Look at non-farm payrolls that came out today, right? Non-farm payrolls grew much more than expected in May, rising 339,000, despite economists polled by Dow Jones expecting relatively modest 190,000 increase, right? It marked the 29th straight month of positive job growth. Now, that's incredible, right? I mean, here's the deal, folks, okay? They were screaming recession, right? And when it was a situation where we didn't get the recession in the first quarter, second quarter, then it was like, we're going to get it in the third quarter and fourth quarter. Look at that job number today. Look at companies' guidance. Look at companies' commentary and tell me how you're going to get a major recession in Q3, Q4. I think by the day, it's looking more and more far-fetched. I think it's looking more and more difficult literally by the day. So then, if you aren't going to get it in Q3, Q4, then they have to roll it out to, it's going to come in Q1 or Q2, right, of 2024. And so they keep kind of kicking this can down the road of like, the big recession. And I think part of the reason why this is happening is because last year we had a true recession, but they didn't call it a recession, okay? But we're in a very intriguing time, folks. Very intriguing time in the market. And honestly, I don't see this ending anytime soon. I think this murkiness is going to continue. I think 1 minute it's going to look great. You know what the next argument they're going to make is? I'll tell you what the next argument the bears are going to make. They're going to say, I already know this is going to happen. This is the next thing they're going to say, okay? Other than rolling the recession down the road. What they're going to say is, the economy's heating up so much, watch out for inflation spiking back up next year. Guarantee you that's going to be the next big worry in the market. Is, the economy is staying way hotter than expected. Yeah, recently the numbers seem to be coming and trending the right way with inflation, but they're going to be saying basically watch out next year, because inflation is going to spike up again, which means the Fed has to start raising rates again next year at some point in time, right? True inflation numbers have us at CPI right now under 3%. I can tell you government numbers are going to 3% range here. So there's no need for the Fed to keep raising rates. No need at all, at least for the next many months. But if the economy stays too hot, inflation spikes back up, then they're going to move to obviously that argument of like, inflation is going to spike back up the end of this year or going into next year. And then the Fed's going to have to drop the hammer again. And then you kind of get into the whole recessionary fears, banks breaking, the financial system breaking, all those sorts of things. Okay, folks, it's just one thing after another. it's a stock picker's market. It's going to continue to be that way. I appreciate everybody joining me as always, folks. I made moves out there here today in the Patreon portfolio. If you want access to see the moves I was making here today, then check out the description area. That's to join us in there. You get to see the stocks I'm buying and selling each week in the Patreon portfolio. Plus, you can be part of the Discord chat as well in there. And once again, if you enjoy the channel and you ever want to say hello to me, say hello on Financial Education Jeremy on IG. That's going to be pinned comment down there. Much love and have a great day.